Hello all, welcome to the first office hours section of our financial fundamentals for food hubs. This office hours is intended to be based around the last two presentations. So that was the introduction and to the common chart of accounts, and then the balance sheet, and really open up the floor after Erin introduces our third panelist for the day.
All right. Well, welcome, Samantha Stoddard. She's my special guest star. She is a loan officer at Farm Credit East in Bedford, New Hampshire. So she deals with balance sheets all day, every day. And I thought, well, it might be handy to have her on the call in case anyone has lender-specific questions. And if those of you who don't know, Gary used to stomp around New Hampshire and still does occasionally. So he's known Sam for a while too. So it's a little mini reunion.
Her question has to do with depreciation. Can you explain the movement of depreciation on the balance sheet? Should it stay eternally?
That point to you, Gary?
Yes, I'm pointing to you.
Okay. Oh, depreciation comes in two parts. One, the part that goes on the income statement that you recognize as an expense. And then because accounting is double entry, you need to put the other half of that entry somewhere else. And when you recognize that expense, since you're not actually paying cash for it, you need to charge it against something. And that something is reducing the value of whatever else you're depreciating. So say it's a truck that you bought for $50,000. If you're depreciating it over 5 years and you depreciate $10,000 a year, you would record that depreciation against the value of the truck. So truck value $50,000 minus depreciation of $10,000 means at the end of the first year, the truck would now have a net book value of $40,000. Now each year you're going to add that depreciation, right? Half of it, or one part of it is expensed on the balance sheet. The other half of that double entry, it accumulates on the balance sheet. That's why it's called accumulated depreciation. And that'll stay with you for as long as you own that asset. When you sell that truck or junk that truck, meaning no longer in use, then not only does the value come off, but also the accumulated depreciation comes off the balance sheet at that time. So a long way of saying it sticks with you as long as you own that asset.
Just to advertise for Samantha's skills as a loan officer, I'm a farm credit borrower. I've depreciated trucks and other equipment, and it's the kind of thing that when I have to submit my balance sheet at the beginning of each year in order to renew a loan, my loan officer will go over that balance sheet with me to make sure that have you added any new equipment in this year? Are you seeking any Section 179? Did you go out and buy a tractor at the end of the year so that you could avoid paying taxes, kind of thing? Let's make sure that gets onto the balance sheet. Because again, the lender is interested in an accurate balance sheet as a way to say, here's the starting point for what we're going to talk about. Your capability to borrow money starts with a balance sheet. So that's why a lender always wants to have a current balance sheet and have one that is accurate, and that for a business that has a lot of depreciable equipment, trucks, packing equipment, stuff like that, it's very important to keep that current.
One thing that you might want to consider is you have a tax return balance sheet which includes the cost of your equipment, and then there's the accumulated depreciation line. Sometimes your lender will ask for a market value balance sheet, and that disregards the depreciation, and the market value balance sheet will be what could you sell that tractor for today. Your book value might be zero because you've depreciated it all, but it still has value. And when your lender asks for a market value balance sheet, it's looking for what could you sell that item for today.
Awesome. You didn't even know that for that.
So there's a follow-up question, which actually, as you guys were speaking, I was thinking myself. The follow-up is, how do I address facility depreciation? I have a hard time with market value versus tax value as it relates to the current value of facilities, right? Similar to the resale value.
Sure. Well, so for the same perspective, your facility is going to depreciate, the improvement part, not the land part, in the same manner. It's just going to have a different useful life as prescribed by the IRS, and that's what you need to follow for accounting and for your book value balance sheet. However, with real estate, you may see appreciation, right, that it goes up in value rather than down. And that's, as Sam was alluding to earlier, that the two aren't necessarily linked in any way. So facility, you're not going to be able to write off under Section 179 in the vast majority of cases. So that's going to continue depreciating on the balance sheet and accumulating that depreciation there. But for a market value, it may actually go up. We see that quite often. And that's why it's important to do both. Once you know what your tax position is, because if you were going to sell it and it was fully depreciated, you'd have a whole lot of gain versus let's look at the market value and see what do we actually own and how much is that worth. If we had to sell it today, would we get any money for it or not?
Joe asks what the maximum depreciation available for equipment purchases in 2016 or 2017 in its first year is. Can you depreciate 100% of value?
Right. The tax answer is always it depends. Do you want to take this one?
It depends on how much total you have spent on machinery and equipment, because there is a thing called Section 179, and that allows you to fully depreciate assets that have a useful life of under 20 years, and that limit is up to $500,000 more or less, based on purchases of up to $2 million. A lot of farmers don't meet those upper limits, so you can depreciate the entire value of whatever it is you purchased if you are under $500,000 for Section 179 and $2 million for total purchases. And then there is also an item called special depreciation, where you can depreciate half of your item. So half the cost of the item can be depreciated in 1 year. And so with machinery equipment that has a useful life of under 7 years, these are two good ways to really juice up your depreciation in 1 year and reduce your taxes today. If you're not making a profit or not a big profit and don't have to pay a lot of taxes, it doesn't always make sense to take advantage of these special depreciation items.
And you also should check with your accountant for your own particular situation, because depending on different kinds of business structures and what schedule things are being reported on, Section 179 is not always allowed. So if you have a rental business, for instance, that's one that is not allowed to use Section 179. So definitely check with your accountant and use it in the spirit of tax planning, because it may be attractive to save a few bucks on taxes today, but as Sam said, if you expect to be more profitable in the future, those depreciation dollars will be worth a lot more to you at that point rather than today. One of those just, don't cut off your nose to spite your face kind of questions. And that's why a good accountant, like all of our tax preparers, sit down with folks and work through that to say, well, you could do this now, and yes, it would save you a few dollars, but you're planning for next year to be really good. Just think about the impact, and then you can decide what to do from a more solid foundation.
How often do you recommend having an appraisal done to establish market value? The last appraisal showed facilities worth 1/3 of what it costs to build. It's hard to find comparables in this industry.
Absolutely it is. So I think the appraisal is something that you do more out of necessity if you're trying to establish a value for a purchase or a sale or a gifting purpose or a contribution to an entity. Otherwise, you can do something quick, like a market evaluation with a realtor, which would give you a real-time value of, here's what I'd sell this for if I was going to list it today. And that's probably good enough for most values.
For lending purposes, we generally like to have an appraisal, a complete appraisal done every 5 to 7 years, so that we understand what is that property worth today, what improvements have been made since the last time we appraised it, so we can have a good idea of really what is its value and what is its collateral value.
And how often would you do one as a farmer, Gary?
Oh, I would consider doing one every time I wanted to buy some property or change my access to credit so that I could have the lender's frequently interested in collateral. So if you're going to be seeking a loan, then understanding that your lender will ask you for the appraisal, it's probably a good idea to be prepared for that and go get a market assessment, a fairly off the cuff, something that a real estate agent could do for you would be wise to do ahead of that conversation with a lender, to say, I've got a good idea of what this market value of this property is. Do we really need to do an appraisal? Is there going to be that much difference in the collateral value if we do a full-blown appraisal, which may cost a few $1,000s? So, it becomes by you knowing what the lender is going to be looking for, that they want to know what your balance sheet is going to have on it for value of that property, you can sort of game that a little bit and say, I'll find out the cheap way what I think this property might be worth. Is that good enough?
All right. Much of this conversation has been around practices for tax purposes. In the webinar, there was talk about how to organize and categorize assets and liabilities to make them most effective for managerial use. But what about equity? Are there any best practices for setting up and maintaining partner contribution versus draw accounts, for example?
Great question. So each partner should have a draw or shareholder, and this is again going to depend on the type of organizational structure you have. Are you a partnership? Are you an S Corp? Are you a C Corp? And your accountant can guide you through that. Depending on how much detail you want to keep and how good a job the person doing the books keeps. Definitely each individual should have an account within that equity. And if you can be specific about it, anything contributed can go in one and anything withdrawn can go in another. Again, the corporations are going to have different methods of getting money out of those, so they don't all flow through equity in that regard. But it's always nice to see who put what in, who took what out. And then at the end of the year, you're going to allocate the earnings, the profits, so in a particular share to each of the partners, partnership, shareholders, and an S Corp, and that'll be distributed among those different accounts too. And that's something that your accountant or consultant can help you with as well. Good question.
I'm curious if anyone on the webinar went back and did their net worth percentage calculation to find out if there's where they are in the stoplight. Just to review. Good job. Just to.
I'm gonna send Aaron a chicken.
So the
and Samantha.
The net worth percentage is your total equity over your total assets multiplied by 100. And in the webinar, it was suggested that if you're less than 40%, you're in the red category. That's danger zone. From 40 to 70%, that's yellow or caution. And then if you have a greater than 70% net worth, you're doing pretty well. Samantha, do those numbers jibe with you?
Absolutely. So when we're doing a loan, our minimum is usually 40%. If it's anything lower than that, then we want to know why is it lower than that? Are there any guarantees? Are there any co-borrowers we can seek to enhance the credit? So 40% is generally our minimum. And then again, like you said, if it's over 70%, that's an excellent risk for us.
Good.
And we know that the equity position is often low, but from the other side of working with startups, That's the thing I think a lot of people don't really plan out, is how much working capital and equity I'm going to need to put in at the very beginning. And that's often the surprise. I mean, Gary, you travel more than I do even. Do you see that commonality throughout the country in terms of, whoa, this takes a lot more than I thought it was going to?
Yeah, the thing that, in general, farm business or any other kind of business, the thing that makes most businesses fail is a lack of working capital. They can't handle the cash flow problem that they have because the income is seasonal, or they got an exception, which is farming, of course, or they had an exceptional expense that they had to cover, or income fell for some, in a farm-related business. It could be a weather event, so that you were prevented from retailing at farmers markets in the month of May, or selling your crop of horticultural plants in the month of May. So therefore, you had a disaster as far as income. Therefore, you have a cash flow problem. So one of the things that beginning farmers hopefully are doing, or any beginning business person is doing, the monthly cash flow, which future webinar, we'll get to that. But also considering all of this, I mean, that's part of why we're doing this series of webinars, is to connect your ability as a business, a food hub operator, to connect the balance sheet, the P&L, and a cash flow statement into an integrated view of what your business is going to do, and most important, what it's going to need, so that you're looking forward, not just with the cash flow, which is typically what you think about as, oh, that's my budget, that's what I'm going to perform to. That's true, but considering what's my balance sheet going to look like at the end of this year, particularly the first year, or the end of the first 6 months, is another way to really make better decisions. That whole, should I buy it or lease it or rent it? Those kinds of decisions at a startup phase are probably going to be much more driven by your balance sheet, or should be driven by your balance sheet, to maintain your capacity to borrow money. It's one of those, Aaron said it in the webinar, never borrow your last dollar, right? If you totally use up your capacity to borrow money, you have no resilience. You're stuck. There's no place to go. Going back to the bank and saying, or Farm Credit, or whoever your lender is, and saying, God, things didn't go the way I planned. I need some more money. I know I've hit my credit limit. What do you expect them to say? It's like, oh, well, the credit limit didn't really mean anything. I mean, that's not what lenders do, because this is driven by shared risk, an assessment of what the lender is willing to risk and what you should be willing to risk. So sort of managing that risk on your balance sheet, or with your balance sheet in mind, is really what the hardest thing for a beginning business to do.
I think it's also important to recognize that there are 4 ways that you can change your balance sheet. Right? Only one is really what you have control over, and that's earnings. Right? The other ways are depreciation or appreciation, like we talked about before. Stuff is going to change in value regardless of what your work with it is. Right? You're going to have gifts or transfers in and out. So if your rich Uncle Charlie passes away and leaves you a lot of money, that's fantastic, but really rather have Uncle Charlie around, right? And the last one is inconsistencies. Something didn't get written down before that is written down now, or we had something on there that, oops, we don't really have that anymore. Why is that still on here? And all of those things are going to affect your balance sheet. The earnings one is really important. And I'll never forget a business startup that said to me, I don't want to do a budget because I don't want to see how much money I'm not going to have in 6 months. You think about what that would mean, right? This business activity would mean to that balance sheet. Is that a good idea or a bad idea?
I tried that one on my wife as far as farm improvements budget, and it didn't go very far to say, I'll just keep spending money until it's all gone.
We're really excited. Maybe that wasn't something he should do for a business. That would be a great hobby, or he could work for someone else to do that. Or, better yet, change the business plan so that it made sense to build that balance sheet rather than erode everything he worked so hard for at that point.
All right, there's a couple questions here for things that may or may not actually go on the balance sheet. So one is, so if you set up partner equity accounts, you would record any draws for each partner. But for this startup, we're contributing our time unpaid as sweat equity. Does that get accounted for as an equity contribution?
In the goodwill of working with your partners, we like you because you were carrying your own weight. It does, but it doesn't put value on it because not put in for that. You know, that's where money changed hands. So where that happens down the road, when you start to earn money because of all this work that you put in, that'll accumulate in the profits, or in the the profits will accumulate in the partner's capital account. But we've got to make that profit before it shows up in there.
Mm-hmm.
Anyway.
No, the sweat equity that you put in, while is good so that we can understand that you want to make your business successful, it doesn't usually show up as a dollar amount anywhere on your balance sheet or your equity, your profit and loss statement.
So one place where I can think of an exception would be if Sam and I were really good carpenters, we bought all the material to build a barn, and we built that barn using our sweat equity. Then the barn is worth more than the sum of the parts that we bought to build it. That's one place where sweat equity could show up on that. In terms of building projects, you know, we had a question earlier about my facility isn't worth what the appraisal was a couple of years ago. That we call lost capital. So even if you put all that hard work in, it may not necessarily accumulate, you know, to be anything. So it's important to know what are the market conditions surrounding you as to whether or not there would be any value to that sweat equity right now. The goal of putting it in, though, is obviously to get a reward in the future. So that's why you're working on that.
Would intellectual property be in that category as well?
Well, that is a little different, because sometimes if you license your intellectual property and you can get royalties, then it becomes money. But if you don't have a mechanism to get money for it, it's a little difficult to put a value on it.
And then that license could potentially be sold, so it would have a value in the marketplace. You know, like you talk about, you hear in the news about song catalogs being sold, you know, who owns the rights to the Beatles songs or whatnot. That would be an example of where there is some value to that. So whoever buys that, you know, has demonstrated there's value. On the tax side, now they get to deplete that, right? Not depreciate. But until that point, a wonderful songwriter doesn't have any way to monetize that, really.
And what about grant grant equity? Should that be tracked separately?
Yeah, I would say that you should track it separately, so that you can. The biggest reason is so that you can keep it separate from earnings. You want to be able to demonstrate earned income, earned equity, as opposed to grant equity. Grant equity is great. Never say no, unless it comes with too many conditions, I guess. But you want to be able to separate it from earned.
And also check with your tax advisor on that, because in the vast majority of cases it is taxable. However, if it was earmarked to build a capital improvement, you could take it as a reduction in basis so that you don't have to pay tax on it at that point. You would pay tax on it effectively by A, not being able to depreciate that amount, or B, when you sell it, you would have additional gain. So definitely want to run by your own advisor for your own situation.
In the webinar, the $1 million question, it was pointed out that grant equity is extremely valuable, far more valuable than a dollar of grant is far more valuable than a dollar of sales revenue, because there's very little cost to it, right? So you're only making a small percentage on each sales dollar. So those grants are nice. One other thing that we discovered in the benchmarking study is that a lot of food hubs use significant volunteer labor, and much of that volunteer labor is just unpaid volunteer labor. So again, we have no cash value. Does that get stored on the balance sheet or some other financial document?
that's a really good thing to know. I think if you've been to our boot camp or some of the earlier webinars, we talked about how it's important to know that figure, because at some point those volunteers may say, well, this is fantastic, I've been doing a really good job, how about a raise? To which they will not like the answer, I'll pay double what I'm paying now. You're going to want some real numbers attached to that. So it's important to know what that is. But right now, that's an artificially low cost of labor showing up on your profit and loss statement. So if you had to go out and hire people to do it, you probably couldn't do it for that same amount. Great work, take advantage of what their efforts and what they have to offer, because that's certainly a way to help forward your business. But just know that that cost isn't really market cost unless you have an unending supply of volunteers.
One thing that you may want to review your grant request for is sometimes the grant requires farmer equity. And in that case, if you have your own labor or you have some volunteer labor, if you calculate how much time and how much was that labor worth, you can use that as part of the farmer equity or farmer contribution into your grant. So that's something that you need to really carefully review with the tax accountant, with whoever your grant writer is, or internally, to make sure you understand what those restrictions are and what you need to have for a farmer contribution.
That's an excellent point. And in fact, other grants have a match requirement, not necessarily a farmer, but like either a cash or in-kind matching component. And your time can be, in many cases, put towards that. This is an excellent point. Question here about prepayment and how to properly account. Direct-to-consumer sales outlets, especially things like festivals, often require or make it more interesting or incentivize registration costs to be paid in advance as a deposit. So how do you best book prepaid expenses or deposits? Or if a hub would be hosting an event like that, how do you best book income from those deposits?
Okay, so think about it in two steps, right? First off, if you are making that deposit, you've prepaid something, right? You're prepaid, say, festival expenses if you're the one paying. And we talked about prepaids are a part of the current assets on the balance sheet. And then step two, when you actually have that festival and you use up that prepaid expense will then get transferred to the profit and loss as an actual expense. You've spent it now. And separate in your head spend from money going out the door and money that is actually used to pay for something. Because in that case, you make that deposit. If you cancel the event within the right time frame, you can get that money back. It's not an expense until you've actually used the services or whatever you're paying that money for. On the flip side, if you take that deposit, think about what that means in your relationship for the person you're taking the money from. You owe them something for that down the road. So if you take a deposit, it's really a liability to you. And as Sam and I talked about earlier, current liability, because you should be turning that into something in the next 90 days. And then once that happens, when you host that event, then you would turn it into event income. And we were talking about, when you use QuickBooks, for instance, very typically we'll see people receive a payment in that case, but there's no invoice against which to charge it until the event actually happens and the services are provided. In that case, you would then invoice it, apply the payment, and be done.
Okay.
Very much taking a deposit.
Did you say it looked like I was thinking? Sometimes you can tell. There's smoke that comes out of the ears and all that. I was just thinking in terms of QuickBooks. I'm not a QuickBooks expert, but if you use the pay bills part of QuickBooks, then that's how something gets into QuickBooks. Will put it as a current asset that are a current asset that you basically are, it will transfer it from the balance sheet to the P&L, to an expense, when you actually click the little button that says pay this bill now. That was part of what we were saying in the webinar, is use the pay bills function so that your balance sheet is accurate and up to date on a much more current basis than doing it once a year.
Calling back to your example balance sheet, you have several categories, for instance, bakery, beverages. What about if your hub is doing some processing? So if you have raw materials or stored inputs, is that thought of as supplies?
Oh, really good question. Okay, so supplies are the catch-all, which is the devil if you're trying to do management records, right? Because if we don't, we put it in supplies, and then supplies ends up being the biggest category on either the balance sheet or the income statement, and that really doesn't help you. So think about what it is you're processing. One, is that big enough? So you're making salsa. Is that a big enough part of your business where you should be looking at that separately? If it is, you're going to want to have all of your supplies on your balance sheet identified so that you can pull them out as they are for salsa. Then you're going to want to have a salsa sales category on your profit and loss, and you're going to have a salsa cost of goods or cost of production account where the variable expenses go. So if you buy the stuff and it's on hand, you haven't used it yet, it's a supply, and then as you use it up, it goes into the cost of production for that salsa. Now, if you're doing a lot of value-added processing and you don't want to keep track of them individually yet, you can do that on a broader range, and it's value-added products or more grocery-like products that you're selling, that you have cost of production you're keeping track of, and that you have supplies for. But I wouldn't just lump it all into one supplies category and call it good. You definitely want to know what you're selling and what's costing you to make it. And that means keeping track of the supplies on the balance sheet, what they're good for.
Right. Yeah, we are working for ourselves here. We're going to work for management, and so you want to see, are things moving properly? Lumping in, that makes sense. All right. What about non-tangible COGS elements like production labor, inbound freight? Are they integrated into each final product subcategory?
Oh, great question. Yes, if you can handle that level of detail, that'd be fantastic, right? Because if you know how much labor it takes to make something, you can make a much better decision about, wow, is this margin fantastic and we should push this product? Or, oh, we really need to do some work on efficiency here in order to make this be profitable for us because we need the margin from it to cover the overhead. So that's a good thing to know if you're able to break down your labor into different categories of what that labor is doing. But that's maybe like step 3 in complexity. If you can separate your labor first off into overhead versus variable, meaning if you've got a manager on salary or office staff that no matter how much production you do, they're going to be paid the same, that would be more overhead. And if you've got production labor that's doing anything from maybe they're doing that processing, maybe they're doing packing, maybe they're doing sourcing, those kinds of things, those I would separate out as variable. And we'll get into the details of that next week in the lecture. But if you can do that, then that'll definitely be a first step in the right direction. Then step 2 would be separating out what does that production labor do? Where should it be included in my cost of production so I know really what it takes to make this stuff. And the same with freight. So if you're getting a load of those tomatoes in the salsa example, that should definitely be included in the cost, because when you think about it, eBay is a great example for this, right? Do you look at the lowest price, or do you look at the lowest price plus shipping when you're going to buy something? What are you really in for? And if you think about it that way, right, because the shipping is included, the cheapest one might not be the best deal, but it really is going to cost you price plus shipping to get that product to you. Same thing with your cost of your input.
And everything, I agree with everything that Aaron just said, but there's still laying on top of all that, there's a is the juice worth the squeeze sort of judgment that you have to make. If you're really looking at salsa as a prospective business line that you really want to know what's going on because you may be making salsa for the next 5 years, the cost accounting is extremely important because you really want to know the detail. If you have this opportunity to do $1,000 worth of salsa that you're going to do for some special occasion, you're going to do it once, I wouldn't worry so much about all of the detailed cost accounting.
Think long and hard about, is it worth it for $1,000? Because the learning curve is definitely there. But I love that question, Jeff. So give whoever it is a high five that asked it, because so often people say, "Oh, there's a freight and trucking line on my tax return, and my accountant needs to put it there." No, they don't. Right? Those are categories, and if your accountant can't figure out how to work with the suggested categories in your own records, then you need a new accountant. Right? It's more important that you know that because you need to manage your business every day.
That's
with respect to farm businesses that file on a Schedule F, I regularly say to beginning farmers, that is not an IRS-approved recipe on how to make money in farming. It's suggested categories that they want to have on there, but there are little blank lines on there too. So you can adapt. You should be able to adapt your results for management that are your own records. Those are separate or could be separate from what you're going to be putting on any given tax return, whether it's a Schedule F or C or S or whatever you're filing.
All right. Perhaps this may be a good one for Gary in the freezer beef market here. Valuing inventory can be difficult when you're talking about animal and animal processing. If the only figure I have is live weight processing cost, do I value ribeye differently from trim, and how?
Wow. I would say you're going to the safe way around that, and I'm willing to be corrected quickly, is you're talking market value here, that you have a live weight value and then you have a processed weight value. If you're holding inventory either as live weight or processed weight, like frozen beef or hanging weight in your cooler, then it has a specific market value as to what you could sell it for. The live animal has a different specific market value, and that's how I would track those two if I actually own both the beef and the hanging beef product.
Mm-hmm.
I think it goes in with cost accounting, right? Because whether it's trim or prime rib, it all ends up being the same to get it to that point. So knowing your costs is really important. It took this much in buying the feeder calf, plus then I need to put in the grain and the hay and whatever else went into it. So it's this much in cost at the point where it goes off to the slaughterhouse, plus I add the processing fees and cutting fees and packaging and whatnot. And now that whole stuff is worth the sum of those costs when we're talking cost accounting. And you need to know that cost so you can make a good decision about pricing. And then with our cashew operation, we did that and then broke it down by, here's what the yield is going to be. Here's what the meat is. Here's our prices for each of those individual cuts. And bones we sell for $1.10 a pound, wraps we sell for $24.99 a pound. There's a pretty big range within that. But putting that in a spreadsheet, now we can see our average cost is $3.95 a pound. All right, if our carcass then works out to be about $6.50 a pound, all right, that's an acceptable margin, and we can work with that, and then try to do a little bit better cut. So that's not an easy one. I'd say that's definitely like step 2 or 3 after you get your P&L in good shape. But a really good exercise if you take the time to do it.
Yeah, and share resources you develop if you're willing. A question about line of credit. Are there any special considerations on the balance sheet for lines of credit as opposed to longer term like real estate loans?
Want to take that one?
Sure. So line of credit, it depends on what you're using the money for, which will just factor in how long you want to repay the loan. So for an operating loan, which generally we think of as paying your labor for this year, paying for things that are going to be used up in the next 6 months, they should be repaid within that year at the end of your operating cycle. So I know this is food hubs, but for farmers, we would advance money for labor and for fuel to greenhouses and expect to be repaid in May, June, or July when they sell their crops. For capital loans, and that's the loan you need to buy your tractor, to buy your processing equipment, that should be done over 4 to 7 years, depending on your cash flow and the useful life of the equipment. And then real estate loans will take anywhere from 10 to 25 years, depending on what exactly it is you're purchasing, what is already on the facility. Is it vacant land? That would be a lower term. If there is already a house or a facility on there, then it would be a longer term loan. So it really depends on both your cash flow and what is the purpose of the borrowing.
Okay, thank you. We have emptied our queue of questions. Anyone else is free to raise their hand or type in your questions. The typing in has been the preferred method, but we'd love to hear your voice too.
Got amazingly warm here. I hear peepers.
I'm in DC. I hear police and fire sirens.
It must be a day that ends with Y. All right. So, given that there are so many different players in the short-term lending market, what is a good range of rates to look for working capital loans? Just to give a sense.
It really depends on who you're asking for and what kind of lender are they. For instance, Farm Credit they lend based on your earnings as well as your collateral, and so we definitely take collateral. So our rates may be lower than someone who is an earnings-based or a cash flow-based operation. For instance, in New Hampshire, we have the New Hampshire Community Loan Fund, and they have rates that are higher than ours because they are looking more at cash flow and less at collateral. So whereas our rates might be variable between 6% for most people, the Community Loan Fund rates might be around 8% because they're taking more risk. So it depends on what you're using as a lender. Farm Service Agency also produces or gives out loans, and they have loan rates that are lower than Farm Credit because they have a different mechanism for funding and a different criteria on which they approve their applicants. So it depends on what you need, what its purpose is, and what your financial station is. Are you able to put up good collateral? Then your rate might be lower than if it's just based on your cash flow.
And then even, I think most local banks have personal lines of credit, which don't include collateral, so you're going to pay a higher rate even beyond.
Right, those might be 9 or 10% would be a common personal loan rate because they are not collateralized.
And then there's always credit cards, right, which could be an easy access to cash, but really easy to rack it up and not have a schedule on which to pay it. That's the part that gets most people in trouble is when you have to be self-disciplined to pay those kinds of things back. No one is going to send you a bill for anything more than minimum, which means it's really easy to rack it up and keep it there. So if you're disciplined and you can do it in the short term, take advantage of a special. I mean, those rates can range from 0% for a little bit to 25 or 30%. So just know what you're getting into. But they're all sources of cash for sure, and you have to match it with what makes the most sense for your business and the particular project.
And also, I think from a little larger perspective, what sort of lending relationships do you have with one or more lenders? If you could go to one lender for a line of credit and a different lender for mortgage credit, but in general, you'd probably have a better relationship and get if not a better rates, if you had all of that business with one lender, because that's what lenders want to know, where they are in line. First mortgage, right? They get paid off first. So a lender would rather, in most cases, a lender would rather certainly know all of your credit, but have all of your credit is for most smaller scale businesses is probably something to consider. You're bringing that lender more of your business, more income for them as they rent you that money, but also more security in the sense that they know everything that you're doing, and you're not using your operating line in a way to pay off your mortgage loan or something like that. Would be a concern if you had more than one lender involved.
I think I've also seen you be able to work with people more efficiently when you know the whole story and work with everything, because you're able to use collateral in multiple ways, as opposed to, that bank has the mortgage, so the land is off limits, for operating collateral or those kinds of things. So relationships are very important. Glad you added that, Gary.
Mm-hmm. And short term should be thought of basically as a year, a business cycle, which is a year, right? I mean, that's short term.
Yes, we consider short term to be operating loans less than a year, and then we have intermediate loans, which are from 2 to 7 years usually, and then long term loans, which are 10 to 30 years.
Okay, good. There's a really interesting question. I'm gonna not paraphrase it, because I'll probably mess it up if I try to paraphrase it. So Peggy says, I'm the treasurer for an online farmers market through Local Food Marketplace. It's the software. And the board was asking about issuing 1099s to producers that we paid out more than $600 to. They use Authentech and Cyberspace as the gateway and payment processor to offer farm produce to consumers that collect payments from the consumer and then pay the farmers. So the systems, right? They're the best. All right. Is the 1099 the hub's responsibility, or is it the payment processor?
Two-part question. Who owns the product? Because if the hub is buying the product from the farmer, then yes, it would be the hub's responsibility. But really good news, you don't have to issue 1099s for products that you buy. It's for goods or services to someone other than the corporation. So if I was shearing your sheep, yes, you'd need to give me a 1099 for more than $600. But if you're buying lamb from me, no, you wouldn't.
Just like buying any other supply, like cardboard boxes or whatever.
Mm-hmm.
Tires for your truck.
So the hub does not take paper here. That does not buy the product.
So say that again?
Sorry. The hub does not take ownership.
The hub does not take ownership. So the hub is a broker?
It's a sale to a consumer. The hub just happens to mediate it, right? So they're a broker. I would say they're not in a money chain other than being paid as a broker, if they're being paid for that.
As a commission, right? But it's still a product, right?
Yeah. I mean the produce, right? It's really the money.
Product based on 1099.
Mm-hmm. All right. Yeah. They aggregate. Okay. Good. Peggy, does that answer?
And that's one of those questions, Jeff. Check it out with your accountant, right? To we're I am not a licensed CPA, so this is suggested. Here's a strategy, but in the end, you got to have your accountant on board for whether you should be issuing the 1099s. And somebody may want you to do that, but in the end, if you have a touchy question about your finances, let's say you do it all yourself, or you have your cousin is an accountant and he advises you. If you get to a sticky situation that you think you're taking on a legal liability or a financial liability or a tax liability, it's time to get a professional in there to bless whatever it is that you want to do.
Okay.
So, not that we're not believable.
Right. But really good point from the aspect of, you and I've talked about this before, Sam, is that folks hear business recommendations on their own personal situation, and then they trade it as coffee shop talk if it's universal. And that's not necessarily the case. So Gary says, making sure you're working on your own situation is really important. But go ahead and look at the IRS website and talk about or look at the Form 1099 miscellaneous income. And that should help you with guidance, but your accountant is going to be the best resource on that. So Gary, we're under $600 for prizes and awards, right?
Yes. I mean, the priceless. They are priceless, but retail value would be less than $600.
Peggy feels like it's not defined well for their situation. I mean, the money to the farmer is for goods, and then Peggy's hub, as I understand it, is doing the deliveries and takes a percentage off the. I assume takes a percentage off the price to run that aggregation and distribution service. So they're 1099.
Farmers?
Or who farmers?
So the places from which they're aggregating it, right? So the hub is collecting the food and distributing it. They're charging a percentage. So is it a fee that the consumer is paying them for the convenience of delivering, or is it a cost to the farmer for the service?
Right.
I think you need to define that helps decide where you go from there. Because I'm just looking at the IRS website description of who needs a 1099. And it's that range from rents, services performed by someone who is not your employee, prizes and awards, other income payments, medical and healthcare payments, crop insurance proceeds, cash payments for fish, cash paid from a principal contract, payments to an attorney, or fishing boat proceeds. So I think you got a lot of room in there, so definitely check it out with your own accountant.
Yeah. Okay. All right.
Watch your fish particularly.
Yeah, clearly something about fish. Okay. I see. She's saying that the farmers mark up the 13%, which then gets paid to the hub.
Can you not talk with the? I mean, I heard earlier that it was the board pressuring you. Is one of them the accountant or not? Because I think really going to the accountant is going to help you on that front. It's definitely wanting to make sure everything is in line, which is appropriate. But if your accountant is handling the tax situation, they would be the best resource on that.
Okay. But a really interesting question. Thank you, Peggy. And we are now at the top of the hour. This is a super interesting session. Thank you all for participating. Thank you, Samantha, Aaron, and Gary, for your sage advice. And we will see you all on Tuesday. For the next session is P&L? Profit and loss? All right. Until then, thank you.
Thank you, Jeff.
All right. Take care.